Hello, I'm Stephen from TEFAT, and today I'd like to give a presentation on depreciation. I'll just set up the tripod in the right place. Let's check it. Okay, so in the balance sheet, in the non-current asset range, some non-current assets are subject to depreciation. They go lower in value, like a car depreciates every year. Eventually the value of the car runs down to scrap and the person needs to purchase a new motor vehicle. So you've got the original purchase price, and the accountant in the depreciation schedule records a depreciation expense for an asset each year, which comes off the original purchase price each year in a timeline to result in a new written down value. So the difference between the written down value from the previous period minus depreciation expense for this year gives you a new written down value at the end of the year. And at the very start in year one, you deduct the depreciation expense off the original purchase price, but that's only year one, because in years 2, 3, 4, 5, it's the difference between previous written down value and minus depreciation of that gives you the new written down value at the end of the accounting period, normally a year. So the depreciation expense for each year is posted to the profit and loss statement in operating expenses, but the accumulated depreciation figure is in the balance sheet. And now I'm just going to put the whiteboard, the video camera on the whiteboard. I'm just going to give you an example of an excerpt from a balance statement, just an excerpt in non-current assets. That's a motor vehicle with original historic price $40,000, less less accumulated depreciation, rather, to give you the written down value figure for that particular year in the balance sheet for that particular financial year. Now each year you debit depreciation expense. Depreciation expense is a type of expense, debit, and you credit change accumulated depreciation. But that accumulated depreciation in that general journal entry isn't total accumulated depreciation just yet, it's only the change. So the figure for total accumulated depreciation is the depreciation expense for all the years in the time period. Okay, and that depreciation expense debit is depreciation expense for 1 year only. Okay, and the credit accumulated depreciation is just the change to accumulated depreciation. As I mentioned, to get all the accumulated depreciation, you've got to add up all the depreciation expense amounts in all the years. Okay, so we've defined total accumulated depreciation, and we've given an excerpt from the balance sheet, which is original purchase price minus total accumulated depreciation is the current written down value of the asset on the balance sheet for that year. Now I'm just going to give an example, 2 questions. Question 1, a company car was bought for $20,000 on July the 1st, 2018 in the used car market, and it's only 2 years old. Calculate in years 1 to 3 the depreciation expense, the written down value and accumulated depreciation in each year. So in year 1, the car, we know that the car was bought for $20,000. Oh, and I'm using the straight line method of depreciation. Did I say that in the question? No, I didn't. I should add that. And I'll just say with straight line method. Straight line we're starting with. Okay. And back to year 1. So the depreciation expense in year 1 is $1,500. It's the same depreciation expense in all the years in the timeline of the asset with the straight line method. The new written down value is the historic price, 20,000 minus 1,500, which gives us 18,500 for year 1. So both the accumulated depreciation and the depreciation expense in year 1 only is $1,500. In year 2, it's a bit different. The depreciation expense is still $1,500, and that's how you calculate written down value from the last written down value. 18,500 minus 1,500 gives you 17,000. But now what's different is the accumulated depreciation figure is now 3,000, because you've had 2 years now, year 1 and year 2 depreciation expense, 1,500 in each year. So you add those two depreciation expenses to give you this figure for accumulated depreciation. And that figure sits in the balance sheet just below historic cost. As we mentioned, it's an accounting standard to write that. And original purchase price minus total accumulated depreciation gives you written down value in the balance sheet for that year. Now back to this, in year 3, the depreciation expense is still 1,500. It's a set amount, and the new written down value is last year's written down value from year 2 minus the depreciation expense, which is 1,500. So now the current written down value, remember that last year's written down value was 17,000. So we put that in the formula, and current written down value equals 17,000 minus 1,500, which gives us written down value in year 3, is it? Just double check. Yep. Of 15,500. Now the accumulated depreciation with the change is 4,500. Now if I was writing that in General Journal just for that year, it would be debit depreciation expense 1,500, credit accumulated depreciation, the change to accumulated depreciation of 1,500. But in the balance sheet, it's not just the change in accumulated depreciation, it's the total accumulated depreciation listed under historic purchase price. Okay, and so the General Journal entry for 2018, debit depreciation expense 1,500, credit accumulated depreciation 1,500, and that figure has to be posted to General Ledger as well. In those T-shaped accounts, depreciation expense and accumulated depreciation. So if you're going to post it, that entry, that goes, you look for depreciation expense, put it in the left hand side, the debit column, but label it accumulated depreciation. Also look for accumulated depreciation ledger, the right hand side, the credit side. It's a credit, put 1,500 in, but label it depreciation expense. So that's the General Ledger posting, and I've already written what we need on the whiteboard. Now, question 2 is calculate depreciation for 3 years using the reducing value method, also called the diminishing value method, at a set percentage of 20% for the year for the same car described in question 1. However, this time calculate the written down value to May the 30th in the last year, which is, I'll just add this in 2021. Now, why May the 30th? Well, the bank has called a director and they need that figure for current written down value because the car's on a loan, and the bank is requiring this information, this data. So we're not calculating the asset to June the 30th, the balance day. It's this special case of May the 30th in the final year because the bank needs it. So that's the question. And also 2021 is a normal calendar year, not a leap year. And I'll just, a leap year is 366 days and a normal year is 365. I'll get to that. Now, in year 1, the car was bought for $20,000 on that date. So the depreciation expense is 20% times the purchase price, which gives you $4,000. Quite a high depreciation expense. That's how diminishing value is different. Remember, in straight line it was only $1,500. So the new written down value in year 1 is written down value equals original purchase price minus the depreciation expense. 20,000 minus 4,000 gives you written down value at the end of year 1 to 16,000. In year 2, so you use last year's written down value, 16,000, carry it forward in the depreciation schedule. The new written down value is the previous written down value minus the depreciation expense in this period. Now, what is the depreciation expense? This time round, it's 20% times the previous written down value, 16,000, which is 3,200 reduced depreciation expense. So to get the new written down value, you simply deduct the depreciation expense from the previous written down value back in the previous year, 16,000. There it is. Yep. So insert that in year 2 to get new written down value. It gives you 16,000 minus 3,200, which is a written down value of 12,800 as at June 30th, 2020, in the second year. Now, remember that year 3 is a little bit different. We're not doing the written down value to the balance day, June the 30th. The director needs this information for May the 30th. So what you have to do now is set up a ratio of the time period that's elapsed from the previous July the 1st, the start of the financial year, and I know in the United States their financial year is the whole year. So in Australia the financial year happens to be from 1st of July to 30th of June of the next year. So now we have to set up a ratio. Now, the number of days in that whole period from July the 1st to May the 30th have to be written down in the numerator. And I think I've still got a little workbook for my notes, if I can find it, in this tub. Let's have a look if I can find that little workbook for months. Is it here? No, sorry, I can't find that. But what you do is you set up a timeline each month: July, August, September, October, November, December, January, February, March, April, May to the 30th only, even though May has got 31 days. So 30 days have September, April, June and November. All the rest have 31, except leap year, which is 29, and a normal February is 28 days in February. So our particular year is a normal calendar year. So in that timeline of all the months, you've got to add up all the days in the months, put that in your numerator, and you divide it by the denominator, which is 365, the number of days in a normal calendar year. All right, and if it was a leap year, you put 366 on the denominator. Then you've got to multiply that ratio by depreciation expense, 20%, times the written down value from the previous period. And let's just get our what that ratio is. So I calculated the ratio as 334 over 365. The written down value in year 3 is year 2's written down value minus depreciation expense in year 3. So the depreciation expense in year 3 till May the 30th in 2021 is 334 over 365 times year 2's written down value times the depreciation rate of 20%. Now, so that means the depreciation expense in year 3 till May the 30th is 334 over 365 times 12,800 times 20%. So that gives, when we do that calculation, the depreciation expense in year 3 gives us the figure 2,560, and oh, sorry, is that it? Oh yeah, that's right. What that 2,560 is that must be the what's the figure for last year's? That must be last year's written down value. That figure. Let's just have a look. So let's be sure of ourselves and get. So 12,800 was the previous period, a written down value. Let's get to the calculation again. 12,800, and yeah, sorry if I said that is depreciation expense. That figure is the written down value for the previous period, year 2. So that ratio times the written down value for the previous period times 20% gives us the written down value of 2,342 and 58 cents. So that's the yeah, that's right. I know what that figure is. That's the figure if you did calculate to June the 30th, right? Because it's a ratio, you're multiplying that by that to give the adjusted depreciation expense to only May the 30th. Yeah. Okay. Yeah, got it. Yeah, we've clarified that. Yeah, sorry, I was just getting a bit confused there. That figure is the depreciation expense had you have calculated to the end of the period, June the 30th, but that depreciation expense is only to the May the 30th. I'm pleased I picked that up. So the written down value in year 3 is the year 2 written down value, 12,800, which we mentioned, minus the depreciation expense in year 3 to date, $2,042.58. So the final written down value as at May the 30th is of the car is $10,450.42. So when you compare the written down value of both methods, in the diminishing method, depreciation expense is quite high at the start of the period than straight line method, but at the end of the period it becomes quite low compared to straight line method. And that can have tax advantages if the company wants to focus on the early part of the depreciation schedule, the early part of the asset's life. If they're only going to be operating in this country for a few years, they want to maximise their depreciation expense for tax benefits. But straight line method has ease of calculation and simplicity and predictability. The accountant knows, would have a fairly good idea what the current written down figure is, but just by doing the calculation in his or her head. Also, the depreciation method might be favoured if the company was having a rough trot in a period and wanted to write down the asset quicker at the start of the period, if the economy was in a bit of a slump. But once you start depreciating an asset, you have to select either one or the other. You can't just change depreciation methods halfway through. That's the ATO rule as at 2021. That's subject to change. I'm not trying to give tax advice. This is just a tuition example, all right? And I know students get a lot of these questions. But if you get a new replacement car later, that's not the old car anymore, it's a new car, you can switch to the other method of depreciation, but you have to stick to it for the whole life of the asset. Okay. Now, with that diminishing value, even though you've written off the car to a high level, when they go to sell that asset in the used car market, say they did, they might find their realised sale price in the second-hand car market isn't too bad, surprisingly high to compared to the amount they've written off. I mean, say those two cars were two separate cars in the fleet, they'd still have similar condition unless they were involved in a dingle. So each year, to sum up, each year the depreciation expense is recorded in the profit and loss statement, and the total accumulated depreciation is written in the balance sheet under historic price. You debit the expense and credit accumulated depreciation. Just the change in that year of accumulated depreciation. And we already mentioned about the balance sheet EBSA. Now, there's not just the depreciation schedule. There's what's called the it's actually the asset register, which is kind of part of the depreciation schedule in a way. It's side by side. But the asset register is original purchase price, accumulated depreciation, oh yeah, actually that is depreciation schedule, original purchase price, accumulated depreciation each year, depreciation expense for this year, and new written down value. I was getting to asset register, which is, and the accountant can flag a depreciation expense in any given year if he or she needs to look it up. So I was getting to asset register. That's the records of the cost of the asset, the price, the location it was bought, identification about it, information, warranties, repairs and maintenance that might be required, the choice of depreciation method, and any other information regarding the asset, when it needs to be serviced. This information can help with effective repair and maintenance of the asset too, if you've got accurate records and enough content about the asset to give yourself little reminders when it needs to be serviced and things. So terms and conditions, length of the warranty, type of warranty. So it might have information when the photocopier is due for a service in a year or two, and it improves the successful use of the asset to promote efficient repair and maintenance. A car, when it needs an oil change and a change of radiator water, when the photocopier needs a new cartridge, keep one on hand. An estimation of when the photocopier needs a cartridge, and so on. So don't forget about that February the 29th in a leap year. You add a day into the denominator in that ratio. If you're finding a point in time during the financial year, for example, September the 30th, find the ratio of days from July the 1st to September the 30th, and if it's a leap year, the denominator is 366 and the numerator is all the days from July the 1st to September the 30th. You have to construct a little workbook, a timeline to label each month and the days of the month, add it all up to get your numerator to September the 30th from July the 1st. That's correct. I just had a point about it'd be a bit tough if they asked you to calculate that in a straight line method. That's not, they could, but that's not really the idea of straight line if you're looking at a certain point in the timeline for the numerator. But more often than not, the questions ask you to do a point in time in the financial year using the diminishing value. That's just a tip. Thanks so much for watching. I'm Stephen from TEFAT, and look out for my next presentation. I've got a full catalogue of my presentations both in economics and financial accounting, bookkeeping on my website TEFAT, and also a Gumtree ad in Australia. And I do offer Zoom lessons for overseas students. Thanks again. Bye.